All right, let's get right into it. Today, we're breaking down the Q4 earnings for Research Solutions, ticker RSSS. This company is right in the middle of a massive pivot, and frankly, this quarter's report gave Wall Street a lot to think about. So let's unpack it. So first things first, what did the market think? Well, after the numbers dropped, the stock jumped almost 6% in after-hours trading. So right off the bat, the gut reaction was positive. Even though, as you'll see, the results were kind of complicated. Let's figure out why. And yeah, complicated is the right word. We're calling the headline results a mixtape. You got some hits on there, some real bangers, but then you also have a track that kind of misses the mark. It definitely requires a closer look. And here's the central puzzle of the quarter. Earnings per share, a solid beat. They came in way ahead of what analysts were expecting. But total revenue, that was a miss. It fell just short of the estimates. Now that's the kind of report that makes you scratch your head, but the real story is buried in the details. The numbers right here tell that exact story. You can see the GAAP EPS at 7 cents, crushing the 4-cent estimate. But then look at revenue, $12.4 million versus an expectation of almost $12.8. So that begs the big question. How on earth do you make more profit than expected when you sold less stuff than expected? And here's your answer. It's a little bit of accounting magic. The quarter's profit got a huge one-time boost, a $1.1 million adjustment from their Scite acquisition. Now, this isn't cash from selling their products, but it absolutely juices the final earnings per share number and explains that big beat. Okay, so let's look past those headline numbers, because the real story, the one that investors are actually excited about, is the engine of this company. We're talking about their big shift into a high-margin software as a service or SaaS business model. This is where the bull case really gets interesting. And this quarter, they hit a huge milestone. For the very first time, their high-profit platform revenue made up more than 40% of the total business. This is the proof in the pudding, folks. Their big strategic pivot isn't just a plan on a PowerPoint slide. It is happening, and it's actually speeding up. And you can see that momentum in the numbers that really matter for a SaaS company. Annual recurring revenue, that's the key metric, ARR, grew 20% from last year, and the platform revenue itself was up 21%. I mean, these are the beautiful, predictable, double-digit growth numbers that investors just love to see. So what happens when more and more of your business comes from that high-profit SaaS platform? Well, your overall profitability explodes. Their blended gross margin hit a record 51%. I mean, the platform itself has an insane 88% gross margin. So the more it grows, the more profitable the whole company gets. The model is working perfectly. And if we zoom out and look at the entire year, the picture looks even better. They set records across the board. Record revenue, record platform revenue, record adjusted EBITDA, and record cash flow. This wasn't just some lucky quarter. It was a full year of fantastic, profitable execution. Okay, so that's the rearview mirror. But what about the road ahead? Well, management spent a ton of time on the earnings call talking about their strategy. And it all revolves around one thing, AI. They're trying to reposition themselves as a crucial behind-the-scenes player for the entire AI ecosystem. Now, the core of this whole strategy is something they call a headless approach. What does that mean? Well, think of it this way. Instead of selling a finished car, they're selling the engine. They let their big corporate customers take their tools and data via APIs and plug them directly into their own custom-built systems and AI models. It makes their product incredibly sticky and hard to rip out. And their game plan here is pretty clever. They're launching new tools like AI rights to solve the giant headache of copyright for companies training AI models. And they're leaning into this idea of becoming an arms supplier for enterprise AI. Their goal is to drive growth of over 40% in Scite, which is their AI native product. And the CEO, Roy Olivier, he really put a stake in the ground. He set a target of hitting $30 million in platform ARR by the end of fiscal 27. Now, to be clear, that's not official guidance. He called it their big, hairy, audacious goal. But it gives you a really clear sense of their ambition and where they believe this is all headed. All right, so we've looked at the mixed headlines, we've dug into the powerful SaaS engine underneath, and we've heard the AI focus plan for the future. So that brings us to the bottom line. What's our call on the stock from here? So where do we land on Research Solutions? Our rating is outperform. We think the market is doing the right thing here by looking past that small revenue miss, which really came from their old shrinking business anyway. The real story is the incredible momentum in their SaaS platform, their expanding profit margins, and a super credible AI strategy. We see a clear path for this company to create a ton of value. And that brings us to our last segment. Based on everything we just talked about, we've cooked up what we're calling an outrageous but plausible trade idea. Okay, so lean in for this one. On the call, the CEO said, and I'm quoting here, "I'm confident we'll be able to move forward with one or more deals in FY26. He also pointed out they have tons of cash and cash flow to do deals without having to issue a bunch of new stock. So our theory is that the market is sleeping on this M&A catalyst. The potential trade? You could look at long-dated call options to get some leveraged upside if they pull off a smart acquisition in the next year. Of course, the risks are real. Can they actually get a deal done? When will it happen? And does the old business shrink faster than expected?" So yeah, it's a bold play. It's a bet that the real story here isn't the mixed quarter, but an under-the-radar M&A signal. The big question is, do you trust this management team to execute? Now, as always, and this is important, this is for informational purposes only. This is not financial advice. Please do your own research before ever making an investment decision.